So what we have done so far in the first two modules is the sales, and we've also done the variable cost. So we went through sales, quantity times price, variable cost, quantity times unit cost, and now we're going to get into the fixed costs, the startup, ongoing, and so on. Okay. So let me kind of go back and touch on what we have done on the Excel side, Excel spreadsheet. What we did was on the sales side, we started with product A, product B, and then so when you're going through it, go look at this Excel spreadsheet and look at the formulas. And one of the things I will say again, I said it at the end of the last module, is that sometimes you may want to pull the data in. What do I mean by that? Variable cost, for example, we multiplied by the quantity. Okay, and so we need the quantity. So I have quantity up here, but as you can see, you can see on the top where the where you can see the formula, it is pulling from the sales tab. And that's what you want to do. You don't want to go in and plug in the information by hand here again, because if you when you do the what if, and if you assume that the volume growth will be different, your spreadsheet has to be connected, and that's one of the learnings you want to get out of financial analysis process. Okay, and again, this is something you're learning. Many of you know. I know how to do it. I've seen you do it, but some of you are not quite sure. Get in the habit of doing it, so this way some of the data that is used more than once comes from the one place, so at least when you change that number, it's going to automatically adjust for every place else. So we did that. We did the quantity, we did the variable costs, and then we looked at the what the gross margin is, and then again over here I forgot to mention the last one. We can look at some graphically and see what it looks. Over here I plotted the graph of gross margin, is how much gross margin is produced from product A and product B. And again, why that is important, because obviously in this case you can see, in this hypothetical case I'm talking about, this business depends a lot on product A, so we got to make sure we pay a lot of attention to product A as you're managing it. On the other hand, the product B creates more gross margin per piece, based on at least the data that I have. So over here I'm also looking to see, okay, how do I kind of keep an eye on which product line is giving me how much gross margin? Okay, so up here is the product A gross margin. What is the product A gross margin? It is the price of that unit minus cost. Where does the price come from? Price come from the price tab or the sales tabs minus the unit cost. Price was 20 and the cost was 15, so obviously the number calculated would be 5. Here we had a price of 15 and the cost of 8. We get that, and this basically shows what is the gross margin, or what percent I'm getting from product A. And again, it is, I'm selling it for, so I'll just make a note over here, I'm selling it for 20. It's costing me 15, so I'm making $5 in gross margin that I can then use to pay for my other bills, and what is left is a profit. So what is the gross margin percent? Gross margin percent is that I got $5 for every $20 I'm savings. So that's your 0.25, or 25%. Okay, and that's what it is. Why is that important? It is important, I think, as a business you can kind of see if your product's gross margin is getting better or worse, what your assumptions are. Also, if it gets ridiculously too high, at least you know that maybe you made an error in your calculations, so at least kind of keeps an eye on it. One comment I would make, for me, when I started to learn Excel and started to apply it, I think one of the good habits to get into is, once you have done the Excel spreadsheet, double check it. Don't go sell your calculator. Make sure you have it so you can double check some of the data points by hand to say, hey, does it make sense or not? Because any computer program, in this case Excel, it is easy to make an error, and so you want to kind of look at to see, just do some quick calculation by hand to see if it makes sense or not. Okay. So now let's go to the, continue with the process. Like I said, I'm going to get into the fixed cost. So first we start out with what is the, something we may need up front. One time, maybe required in the first year, sometimes maybe in the first or second year. And this one could be, so I say, for example, let's say, it's one time I'm starting the business, I might need some fixtures, some small equipment, could be, I can buy it used, some stuff that is perishable, some marketing, maybe do marketing blitz and so on. And there could be other ones that could be startup expenses, which is a fixed asset that are more longer term. Things could be maybe some equipment or maybe facility renovation. So we'll talk about this first, okay? And then we'll also talk about this and also the ongoing stuff. I gotta go down, sorry. So in my example, and again your example may be different, your numbers may be different, but just want to show you the methodology. My example, my assumption is that I might need some fixtures and some cleanup I have to do, and I might print some brochures, and I might need some, maybe some used furniture, I might do an open house, I might do a marketing blitz, and it's going to cost me so much in year one, so I got a total of $5,200, and that's my estimate. Okay. Some logic behind it, obviously higher the number, bigger the number. It's good to have more precision. Smaller the number, if you're going to spend $20, $30, that's your approximation is good. But if you're going to spend $30,000 or $10,000, you want to maybe be a little more precise because you obviously want to put your energy in making quality, analysis more on the numbers that are more higher, that are more important. If you were wrong, it's going to hurt you more. So that's why you want to pay the attention. Okay. Now, what if you have some investments and you had in your, and you may not, but suppose you did, how would you do it? So let's say you had investment in making something where the life of the asset is more than 1 year. It could be like a car, a truck for the business, a van for a business, any facility renovation you're going to do. In that case, you cannot take the money you have expensed, you got to depreciate, as you may recall from your finance class. So let's say in this example, I'm assuming there are two types of equipment I'm buying, equipment 1, equipment 2. First one is costing me $20,000, second $10,000. And assuming this one can be depreciated straight line 10 years, and again, you can make a straight line assumption for your business model. But in the real world, if you're working with an accountant, depending upon the type of the asset, as you may recall from your finance class, the type of the asset will dictate what kind of a depreciation schedule you will have, and you can apply it. But for this class, you can assume straight line, and you can assume 10 years or 5 years, as long as you can list the assumption you are assuming. But once you made the assumption, let's say in this example, I'm assuming it's 10 years. So I got 10 year over here. I'm spending $30,000. 10-year depreciation mean every year I depreciate one tenth of it. So I take so every year I'm basically doing 1/10 of it. That's what's going to happen. So what happens to my book value? Book value basically means is that I have something that was $30,000 when I bought it the day one, and the book value was 30. And by the end of year one, I depreciated 27,000, and then another 23,000. So depreciating 3,000 every year, and because it is a equipment that can depreciate in 10 years, obviously by the end of the 10 years, the book value will be 0. So this depreciation item will be included in the income statement. The net book value is included in the balance sheet. Okay. Now, what about if you have other costs that are going to be ongoing? You will need them to run the business. So for example, let's say you have rent, you have utilities, you have staff. Staff could be you. Let's say you're going to pay yourself $55,000 salary, insurance for your business, any maintenance costs, ongoing advertising, any legal accounting, or whatever they are. You list them, and that's your R and your estimate per year what is going to be. And then you're going to forecast. How do you do that? I would assume at least an inflation rate. In that case, you can assume one number because typically you're assuming an inflation rate to grow every. So now you're basically taking this number and on the calculation, taking this and doing this calculation. Again, I want to show you the Excel spreadsheet in a second. And so now you're basically forecasting all the items. You add them up, and that becomes your ongoing operating cost. Again, that's going to go on our income statement also. So let's look at the Excel spreadsheet. remember it's number 12 here, so you can tie it back to the numbers. The startup expense was, fixtures and so on, and again it's here, and it's going to get pulled from here into the income statement. Depreciation, again, 20,000, 10,000, 30,000. This is a calculation, as you can see. If you can see it up here, what the formula is, and then continues to go through that. This is the book value, and again, when you open your Excel spreadsheet, this one, you will see how the formulas are done. Ongoing, again, we start out with what the year one will be based on our estimate. We're assuming inflation, so this will calculate it based on the inflation formula. You can put it in. It'll do that for you. And so now we have done the operating costs, and next thing we will get into will be the income statement. Okay. So what I want to do is to show you on Excel what would that look like. Okay. Income statement. Remember I told you that in the very first slide, I told you we'll have an income statement, and I'll tell you these are the pieces that are going to go in there, and I also told you we're going to go through step by step, which we just did. So far, what have we done? We have done the sales. We did that. We did the variable costs. That is just a calculation, which is this minus this, which is the gross margin, amount of money left after you paid for your variable cost. Startup expenses we came up with in our numbers. Again, it is being pulled from the tab from the startup expenses. So it should get pulled in case we change the number, we'll change the income statement. A startup expense assumption in my case, I did not have any more. I did it one time. I have some ongoing operating expenses which we had, and they grew, and so that is coming from the ongoing operating expenses tab. Depreciation is coming from the depreciation tab. And so now what I have is what is called earnings before interest and taxes. Okay, earnings before interest and taxes. And again, if I do the math, I will come up with a negative 9,700, and then I got a positive number over here and a positive number over here, and so on. Okay. Now, so far, we have drawn this number, and right now I have 0 for interest, because we haven't decided yet in the journey so far is how much money I will borrow. So this is why this is more like a starting point for the income statement. So what we want to do is to say, okay, right now I want to assume the interest is, and assuming the interest is not there, which means I'm not borrowing any money, what would my income statement look like? Again, I continue. Earnings before taxes is that number. Tax assuming 25%. Obviously no taxes in year one because I'm not making any money, it's losing money, and then I pay taxes on this, so it would be $302 on that number. As my number grow, 25% to $29.96. As I make more, the taxes go up, and this is the net income. This net income basically is amount of money left over after all my expenses, including the taxes. Okay. So we have done our income statement. Hopefully by now you know how to do it. Okay. Done the sales, you've done the variable costs, and again, everything should be pulled from your tab. So this way, when you do change any of your numbers anyplace else, they should be all connected over here, which I'm sure you have done it, but in case if you forgot to do it, I would double check it. Okay. So that's where we are. And again, as you can see on this tab, it says without interest. Okay. And later on, there will be one that would include the interest. Now, the reason I have not included interest yet is first thing I want to do is to figure out how much money will I need to start this business. And in order to do that, I have to continue with my planning process to figure out what else do I need. What else do I need, and how do I come up with the cash flow? So the next subject we are going to talk about is going to be working capital. Okay. So I want to talk about working capital. So what is working capital? Working capital has three pieces. We're going to talk about only two of them. Startup business typically The third one doesn't apply, but I'll say it this way. At least you can just kind of getting back to your finance class you took. Working capital has got three pieces: inventory, accounts receivable, and I'll describe each one of them, and accounts payable. Okay. Inventory is stuff that you physically have. If you got a shoe store, you got shoes on your shelf, that's inventory. If you got a donut shop, you have some flour and sugar and stuff, that's inventory. If you're a service business, you will not have inventory. You may have some, let's say salon, you may have some, maybe if you sell aside from service, which is cutting hair and, doing hair, you may have shampoo that you may sell, that could be the inventory. If you are legal service, accounting service, if you're not selling anything physical, you may not have inventory. Accounts receivable is that, especially for the new business, your customers may not pay you right away. They might pay you in 30 days, 15 days, whatever. That's the amount of money that you have to wait for till you have it as a cash. You're giving them the service, but you got to wait for it. Accounts payable is the opposite of accounts receivable, as you may recall from your finance class, and that is that you have bought something from your supplier and you haven't paid them yet, so it's accounts payable you owe them. The reason I'm saying that we will not include it in this conversation is startup small business. Typically, it is very, very hard to get stuff from big box stores on credit. I mean, I'm not talking credit card. I'm talking about that you don't have to pay them for so many days. So the more prudent thing to do is to account for inventory and accounts receivable if they apply to your business. And so next thing is to make an assumption is on average how much inventory will you carry. So in this assumption I said, okay, what if I carry 1 month's worth of inventory, which means if I'm selling so much, I'm going to carry 1 month's worth of inventory, and also I'm going to assume 1 month's worth of my sales is on credit or accounts receivable. So in Excel spreadsheet, I can put in a number in 1 month. I can make it a 2 month if I want, and I'll show you what that will do. And same thing with accounts receivable 1 month. And from there I can calculate. So how do you calculate the number? Inventory will be calculated. You take your cost of goods sold for that year and divide it by the number of months worth of inventory you're going to carry. So you're going to take your cost of goods sold from your income statement tab, divided by this number 1, you're going to get that number. Accounts receivable is going to be sales divided by 12, okay? And so you get the sales from your income statement, you get divided by that, and you add them up. So basically all that means, if this particular example, if I need inventory and if I need accounts receivable, I will, for this particular business model, I will need $34,916 worth of working capital. That means I'll have to tie up my cash up front, so I need that. Now as my business grows, which is a good thing, and if I want to carry 1 month's worth of inventory, I might have to add a little bit more to account for the growth in business. I will need 3,000 more, and then I will need 5,200 more. So this is really, because the business is growing, I need to have more inventory to support it, or accounts receivable to support it. Okay. So how is this all calculated? Well, inventory comes from cost of goods sold, which comes to income statement, divided by this cell, which happens to be 1 month. Accounts receivable, sales divided by number of months you're going to carry. You add them up. Change in working capital, obviously starting with that. Then change in working capital is how much is it changing from here to here. Okay, so you're taking basically, every year you're seeing what the change is, and that's what. So this is the change from here to here. This is the change from here to here. This is the change from here to here, and so on. Okay, this will become important when we start to look at the cash flow as the time goes on. Okay. Now graphically you want to show it, so basically all I've done is taken the data and showing graphically what it look like, and that basically says that my working capital that I will need to support the business will start at about 35, which is right this number, and it's going to grow. Why? Because the business is growing. To support it, I will need more working capital. The change in working capital is basically looking year over year change, so it starts at 35, and then I got to add some more and some more and some more. Basically that's the change which I'm adding to it. Okay. So this basically means in year 1 I will need so much cash to support it. Year 2 I have a little bit more to support working capital. Year 3 I need a little bit more. Year 4 I'll need a little more, and so on. That's the change in working capital. So let's go to the Excel spreadsheet. Excel spreadsheet, the working capital. Again, this is the month I'm assuming is 1. For inventory, I'm going to carry this is 1. This is basically taking the sales from the income statement divided by this thing. This is accounts receivable. I'm adding it up and then I'm calculating. Let me show you just so you get a feel for it, why it is so important, especially if a business has a lot of inventory. Now, in your business plan that you are doing right now, this may or may not apply. But chances are you could end up somewhere in your career in a business where inventory does matter, like a retail store or a manufacturing companies or places where inventory matters or place where the accounts receivable matters. I think you want to be very aware of why this is important, okay? And like I said, when I started this module in the very first module, I will every so often digress to talk about the concepts, kind of tie it back together for you. And even though you have been exposed to and learned in the finance class, it has been a few months since you took it in case, so I just want to make sure you are, as you're leaving this program, you kind of make sure you're aware of the importance of this stuff. So for example, let's say right now we need a working capital of 34,917, which is the year 1. What would happen that if my business, when I'm carrying a lot more shoes in my store and taking me 3 months on average to sell them. So let's say this number was 3 months. Okay. Look at what happened to the number. From 30-some thousand we had, it grew to 63. Why? Because now my business requires a lot more cash tied up in inventory. And hence, one of the reasons you're going to find if you are in a retail store or departmental store, be like Home Depot or Macy's, or manufacturing like Hamilton or Pratt or some other factories or other operations, that they really work really hard to work on the inventory cycles and now want to carry as much as possible. Same thing applies. Suppose I change the accounts receivable. Suppose your business model is such that your customer is going to pay you, instead of 1 month, going to pay you in 2 months. Now our number grew 84,000. So this we can see why working capital is so important when you're starting to look at your cash flow. Okay, so now I'm going to go back and put it back to where we started from, so this we can tie it all back together. And again, really important for you to understand it. The reason I'm giving you the Excel spreadsheet, so you can see the formulas, I'm giving you the PowerPoints, you can relate to it and so on. Okay, now that we have done all that, okay, I'm going to take a break here and close this module, and then we're going to get into the next module, which will be the cash flow. Okay, so we have done working capital. We assume, make some assumptions, done the calculation. We kind of look to see graphically how it looks like, so we get a feel for it. And again, sometimes graphically, if you made an error in the Excel spreadsheet, especially the Excel spreadsheet's got thousands of numbers, sometimes we get a little numb to it. By taking some key data out and graphing it, it kind of gives us the, make sure the numbers are kind of sensible and kind of make sense, and we have not made some typo errors. Okay. So I'm going to stop here, and the next subject is how do I take all this stuff that we talked about so far, and how do we take it and figure out how much startup capital I need. From there, we'll make some assumptions about how much we borrow versus equity. From there, once we decided how much we're going to borrow, we can figure out the expense report. Then we can update our income statement, because when we did our income statement in the first round, we did not have the interest because we had not decided how much we're going to borrow. And then we can continue the conversation.